Kevin Warsh just did something no Federal Reserve chair has done in over a decade. He refused to tell the market what happens next. No dot plot, no rate forecast, no roadmap. And in the silence that followed, gold lost more value in one press conference than most investors see in a year of gains. So the question tonight isn't whether the Fed made a decision, it's whether Kevin Warsh just triggered the beginning of the biggest precious metals repricing since 2008, and whether silver is about to do something gold can't. Stay with me. Because by the end of this video, you're going to understand something most retail investors watching the news tonight completely missed. Let's establish the facts first, because this market reset didn't happen in a vacuum. On June 17th, the Federal Reserve held its key rate at 3.50 to 3.75%. Unremarkable on the surface. But underneath that headline number, something structural cracked. 9 of 18 Fed officials now say they support at least one rate hike before the end of this year. Back in March, that number was 0. 0 to 9. In 3 months. That's not a policy adjustment. That's a regime change. And Warsh didn't stop there. He announced 5 internal task forces reviewing everything from how the Fed communicates, to how it measures inflation, to how it manages its balance sheet. He cut the length of the Fed's policy statement in half. He signaled that press conferences themselves might become optional, speaking only when he decides he has something worth saying. Analysts are calling it the return of the Greenspan era, the pre-2008 world of short statements, minimal guidance, and maximum unpredictability. Here's what should make you sit up. Most people watching this story think it's simple. Hawkish Fed chair equals higher rates equals bad for gold. End of story. But that's the surface level read. And surface level reads are exactly how weak hands get shaken out at the worst possible moment. Here's what the headlines aren't telling you. For over a decade, hedge funds, macro desks, and algorithmic trading systems have built their entire strategy around reading the Fed's forward guidance. Predictable language, predictable dot plots, predictable press conferences. Warsh just deleted that playbook. When you remove forward guidance, you don't remove volatility, you concentrate it. Every Fed statement now becomes a binary event. Every speech becomes a landmine. And markets that spent 10 years pricing uncertainty are now being forced to price in the one thing they hate most, the unknown. That's not bearish for precious metals. Historically, that's the exact environment where gold and silver stop behaving like commodities and start behaving like insurance. Now layer in what's happening underneath the surface. Inflation just hit 4.2%, a 3-year high, driven largely by an energy shock tied to the Iran conflict. The federal government is carrying a debt load that's now consuming a record share of the national budget just in interest payments. The dollar is sitting at its strongest level since May of last year, which is crushing industrial demand for silver even as physical shortages tighten underneath it. And here's the divergence almost nobody is talking about. The World Gold Council surveyed 76 central banks this year. 89% of them said they expect to increase their gold reserves, not decrease. Increase. A record high. So you have retail traders selling on fear of higher rates, while central banks, the most institutionally patient buyers on the planet, are doing the exact opposite. That's the split. Retail panic on one side. Sovereign accumulation on the other? This is where you have to ask yourself which side of that trade you actually want to be on. Weak hands see a 9% single-day drop in gold, and they panic sell into it. That's what happened back in January, when Warsh's nomination alone knocked gold down nearly 10% in a single session, and silver, brutally, lost over 30% of its value in the same window. Smart money did the opposite. Within weeks, gold had clawed back $400 from those intraday lows. The sell-off wasn't a fundamental collapse. It was forced liquidation in an over-leveraged market. Paper positions unwinding, not physical demand disappearing. History shows this pattern again and again. The people who get shaken out during the volatility spike are rarely the same people who capture the move that follows it. Quick gut check before we go further. Drop it in the comments right now. Are you hold or are you empty? I want to see where this audience actually stands going into the next few weeks. So where does this actually go? Imagine 2 paths. In the first, Warsh's inflation-fighting credibility holds. He raises rates once, maybe twice this year. Real yields climb. Gold grinds sideways, maybe drifts lower in the near term, testing the $4,000 level analysts are watching closely. In the second path, and this is the one institutional desks are increasingly positioning for, the Iran-driven oil shock fades, inflation cools faster than expected, and Warsh pivots toward easing exactly as Treasury officials have hinted he should. When real yields compress, gold historically moves fast in the opposite direction. Goldman Sachs, even after gold's worst monthly drawdown in over a decade, held their year-end target at $5,400. JP Morgan's commodities desk has a target north of 6,000. Those aren't fringe numbers. Those are the institutions that move billions of dollars based on exactly this kind of Fed pivot. Now think about silver specifically. Silver doesn't just track gold. It amplifies it in both directions. It's smaller, it's more industrially exposed, and it's sitting at the intersection of two massive demand stories: safe haven positioning and the exploding industrial appetite from solar infrastructure and AI-driven data center build-out. When the move comes, silver has a documented history of moving faster and further than gold on the way up. That's the setup. Structural Fed uncertainty, record central bank accumulation, a market conditioned to overreact to headline volatility, and an industrial demand base for silver that isn't going away, regardless of what the Fed does next. Now, credibility means being honest about what could go wrong. Warsh could genuinely deliver on the hawkish path. If inflation doesn't cool, if he does push through 2 rate hikes this year, gold and silver could stay range-bound or drift lower for longer than bulls expect. Volatility works in both directions, and anyone who tells you this is a guaranteed outcome is selling you something. There's also the dollar strength headwind, which is real, and which has already hammered silver's industrial demand narrative once this year. Nothing about this setup is risk-free. This is not financial advice, and precious metals carry real volatility. Always do your own research and understand your own risk tolerance before making any decision. Here quotes the question worth sitting with tonight. For over a decade, markets outsourced their thinking to Fed guidance. Read the dot plot, follow the signal, trade the certainty. Kevin Warsh just took that certainty away. And maybe that's the real story here, not whether gold crashes or silver explodes, but what happens to a market that's forgotten how to think for itself the moment its training wheels get taken off. The people who win the next 12 months won't be the ones reacting to every headline. They'll be the ones who understood the mechanism before the crowd did. So tell me, do you think Warsh is quietly setting up the conditions for the next major easing cycle, or is this genuinely the start of a sustained hawkish era? Drop your take below. I read every one of them. If this broke something open for you, subscribe, because the next few Fed meetings are going to move fast, and you don't want to be the last one to see it coming.